Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Agti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
In this episode, Aaron and Trishul go through President Biden's tax plan, which could be enacted with a Democrat-controlled Congress. Increasing income, corporate, and long-term capital gains taxes, eliminating the step-up in basis, and reducing estate tax exemptions may seem monumental, but likely these changes will only affect about 1% of us. Even so, some of Biden's other proposals could lower taxes for the wider population, such as a new retirement account contribution credit and increased credits for children and dependents. Nothing is set in stone yet, but knowing what can come can still allow you to better prepare for the future. And now, onto our conversation.
Hi, my name is Aaron Agti. I'm a financial advisor in the Bay Area, and I'm here with Trishul Patel, a wealth manager on the East Coast.
Hey Aaron, great to be here today, and thanks everybody for listening.
Great to be here as well. So, Joe Biden got elected president in November. He got sworn in January. There was the special runoff election for the Senate in Georgia. And so while there was a Joe Biden tax plan, Trish and I were kind of pushing off this conversation until we had some better idea of the likelihood of being able to implement some of the ideas. And so we're going to talk mostly about what the proposals have been, not necessarily final results or not getting too specific on numbers, but some of the bigger concepts that have been part of the discussion throughout the election cycle. And now that Democrats control the White House, the House of Representatives, and the Senate, some of the things that might be implemented and how you can start to think about those. So Trishul, do you want to kind of give us some of the high level, what are some of the concepts that came out in the Biden tax plan proposal that you were paying attention to?
Yeah, happy to provide some context. And I'll definitely put a caveat with all of this in terms of the notion that, again, this is all high level and there's nothing really concrete that's come out. So there's a good amount of speculation that's been tied to a lot of the stuff that we're going to speak to. And what we also need to tie that back to is, yes, we have the Democrats in the White House and controlling both houses of Congress, but also we need to realize that even though they control the Senate with the tiebreak vote from the vice president, that doesn't really mean that all of these policies can easily be pushed through. 50-50 vote in the Senate plus a tiebreak won't be enough to perhaps get past the filibuster, so that it looks like there still would be friction to getting all these past the door. So it's not like all of these are even likely to come to fruition anytime soon, and there would be some negotiation that might need to happen to kind of flex on these key points here and there. So that's just something to keep in mind as we run through these topics.
Okay. So I think that the biggest one that tends to grab the headlines is increasing tax rates on incomes over $400,000. I think that was for some reason that number has become I don't want to say a benchmark, but it's like it's become the anchor point that a lot of other conversations, ideas have come around, that Republicans, especially during the election cycle, would focus on the Biden is increasing tax rates. And Biden would try to make it as clear as possible. It's only if your income's over $400,000. If I had to guess where that number comes from, I think if you look at income percentiles in the US, the top 1% of income earners, so it's not necessarily assets or net worth, but the top 1% of income earners is about $360,000, depending on kind of household and year and data, but that's going to be pretty close. So he just rounded it up to $400,000. Nice round number. So I think he was really trying to target that top 1%. He was kind of really trying to focus on your income taxes will not go up if you're in the 99%. So, Trisha, when you first kind of see that, trying to set politics aside, well, that's kind of the huge driver of this number. When you hear that income tax rates will go back to what they were, so I think it's a top rate of 39.6% for incomes over $400,000. What's your first kind of thought and commentary?
Well, when I hear that number, I just try to again calibrate it to how much impact that's really going to have first on the average person. Again, probably nothing, because we're not talking about the average or median person in this case. But also, if you're making let's say 400,000, that means you may not change at all. It's every marginal dollar above that amount, so that's something to keep in mind. The other thing to realize is the changes may not be as drastic when we look at the actual tax bracket changes. So what we've heard at least is there used to be a higher tax bracket that was upwards of 39%, 39.6%. And that was kind of squished down to 37% over the last handful of years, since 2018, I believe. So now that 37% is going to hop back up to the 39%. And then also that 39% is going to go all the way down to 400,000, whereas currently there is a bracket that's 35.6% between 400 and about 600 and change. So what that means is, between 400 and call it 700,000, there's going to be some changes where you might be paying an extra 5% or so, or a little bit more if you're higher up, a little bit less if you're closer to that 400 cutoff. And again, that's on every marginal dollar above 400,000. And Aaron, you made a great point. Again, that's likely to affect 1% of the population. Now, one thing we want to make clear, though, is the Biden tax plan hasn't said if this applies to the individual or to married couples, meaning is it $400, and if you're 400,000, sorry, if you're single and if you're married, does that double to 800? We're not sure of that particular point.
Okay, and I think is also looking to increase it for corporations. I didn't have quite clear on, but it looks like do you know if this is all corporations or is it corporations with income over that 400,000 number?
Yeah, I'm not specifically sure on that, but I have heard that the corporate tax would also be increasing. So that's something that was also brought down during the Tax Cuts and Jobs Acts of 2018. It went down pretty significantly. I think it was in like the 30s or close to 40%. It ended up in the 20s. So that was a pretty big drop for corporate income across the board. And there's a chance that those will float back up to where they used to be. And again, it might be just for if you're above those income levels.
Okay. So I guess I'm guessing that I'm trying to think of how, I'm thinking small business, but most small businesses wouldn't be corporations. That those would be usually have tax income passed through to the owners for small businesses. But if you do have a business generating over $400,000, and you're more likely to be incorporated, so it's possible that there's not much difference there. So probably doesn't affect most small businesses that people, in terms of that, the way people think about that. It only affects corporations. Do you want to provide a kind of quick opinion on the idea of raising the corporate tax rate back up? I know you've talked about this pretty well in the past, and I I'm curious what your thoughts are on the corporate tax rate.
Well, yeah, what we mentioned in the past is when we dug into taxes in more detail, one thing I wanted us to shift the focus to is looking at this notion of effective tax rates, meaning what we hear in the news and what we hear in terms of sound bites and what we've actually discussed so far is this notion of marginal tax rates, meaning how much do you pay on each additional dollar. But what really matters in general is how much tax are you paying per dollar of income earned in total. So it doesn't matter if the $1 billion you earn is taxed at 90% if every dollar up till that $1 billion is taxed at nothing. So we want to figure out what's the weighted average of all the taxes all in considered. And we don't want to only consider the marginal tax rate. We want to consider all the deductions that you can have as an individual and as a corporation. We want to consider all of the other various types of taxes that come into play, whether they're sales taxes, use taxes, whether they're different taxes on property, real estate, and so on. So when you add all of these different taxes up together and you look at it compared to somebody's income, you get something known as the effective tax rate. This is the total amount somebody or some corporation is paying on per dollar of income earned. And when we look at these numbers, we actually find something a little strange that beyond what we were hoping for with our current tax system. Now, this is certainly a longer conversation, and we can dig into that longer conversation by, probably checking out that older episode. But the Cliff Notes is essentially that the American tax system is designed to be progressive in nature, hopefully, meaning that the more you earn, the higher percentage of tax you might pay. However, with all of these various deductions and abilities to take advantage of things if you earn more income rather than things that you can take advantage of when you earn less income, lead to a situation where the tax rate on an effective basis doesn't really end up being as progressive as perhaps we would like. And what we noticed for corporations, for example, is the larger corporations ended up paying a smaller percentage of an effective tax rate as compared to smaller corporations. They've been able to use their scale to get their tax rate lower through various means. And that's true also for higher income earners as well.
So I remember, I don't know if we talked about it in that episode, but when the tax law changed in 2018 to reduce the corporate tax rate, I was trying to consider the global competitiveness of some of these big corporations where now there's so much income generated outside the US. There's so many kind of tax gains in different tax jurisdictions that I was kind of okay with lowering the corporate tax rate to be more competitive with the rest of the world. I didn't quite know how to phrase that more succinctly. But one of the things that has happened over the last few years, this is probably actually over the last almost decade, is US large cap companies have thrived at so much more, one, than the long-term average, two, compared to pretty much every other asset class. Now, I don't want to make the presumption that the lower tax rate on corporations increased stock prices of those corporations. That's a factor, but there's so many other things that would go into that. But it does help corporate profitability. And so it is possible, again, not a one-to-one correlation, but that the lower tax rate helped US stocks and those corporations grow to large asset sizes, that maybe we were already at I don't want to say equilibrium, but we're already at kind of a competitive enough tax position where the US corporations definitely have this capacity to pay a little bit more in taxes without really affecting kind of long-term profitability, especially kind of compared to other similar sized corporations in other parts of the world.
Yeah, that's a good point. It's something that we touched upon in probably also another episode where, again, the larger corporations using their scale, they can say, for example, that all of their expenses are in the US, but all of the revenue and profit comes from another jurisdiction, which has a lower tax rate. And that can lead to lower bills overall. The other thing to think about is we have this notion in the US now that corporations are people. And if we follow that analogy forward, well, here there is still a big difference. For example, if I'm a corporation, hopefully then what I should be able to do is I should collect my income, pay for all of my expenses, reinvest in myself, through education or whatever I need, and then whatever sliver is left, then I would pay taxes, because that's what corporations do.
Mm-hmm.
And that's a big difference. Whereas, with corporations, yeah, they take in their revenues, they pay for every expense they can think of, right? And they reinvest in their future by buying more property and all of that. And there's deductions associated with all of this. And then whatever sliver is left, hopefully nothing is left according to their accountants. That's what they pay taxes on.
So I don't want to go down that path, but I'm like almost wondering, like, is the rate less of a concern with rather than the how many expenses are deductible?
Well, again, this is a whole other bag of worms beyond the Biden tax plan.
Biden tax plan does not address this at all.
Well, it tries to. It tries to bring back a little more progressiveness with the tax code. And maybe it tries to button up some of these things. And maybe we'll see that, yeah, there's a few other bullet points here that might go some ways with some of this stuff. So I can say it's probably doing some things to help.
Okay. So I think we probably spent more, definitely allotted more discussion time than the 1% of people it's going to impact. I think that was one of the kind of clear things, is that the tax increase on over $400,000 of income really only affects like that top 1%. I mean, literally the top 1% of household income earners. I don't quite know how that worked with corporations, but the vast majority of people, your incomes would not change based on the increase on tax rates. The next kind of component of the tax plan was looking at long-term capital gain treatment, especially on incomes over $1 million. So it looks like it would be long-term capital gains no longer get preferential tax treatment if total income is over $1 million. And this is something we have talked about in the past, related to how the tax system has kind of penalized or been less advantageous to income earners than it has been to those who already have wealth or assets. And we've had a few conversations with clients and prospects who have high W-2 incomes. And it's like, well, no, if your employees, other than your 401k contribution, a few other small things, there aren't any big ways to reduce your taxes. Compared to a small business owner, like you said, with all the deductions you get, there's actually a lot of ways that you can reduce your taxable income as a business owner. But it looks like this would be one of those things that's trying to address that. So on incomes over $1 million, instead of getting the 15 or 20%, I guess at that high, it'd be 20% long-term capital gains rates. You're now going back to ordinary income levels. So my first thought is, just for those who have stocks and investments with long-term capital gains, would we be spreading this out longer? Would we try and kind of sell some but stay closer or under that $1 million income number? And so I'm curious for you, one, do you kind of agree with that, my initial thought, or did you have a different initial thought? And two, try to think what the ramifications might be of that, either for individuals and their investment risk, or for other bigger perspectives.
Yeah, so I guess my initial thought when I first heard this one is I do kind of see some sense in the actual proposition. And again, what it's saying is currently, if you have $1 million in capital gains, you would pay 20% plus a 3.8% surcharge, so roughly
The net
24%.
investment tax, income tax to,
Yeah,
yeah, for I
it's
think it's incomes over 250 pay 3.8% as the Medicare and Affordable Care Act surcharge.
right. Yeah. If you're married and filing jointly, over 250. If you're single, over 200.
Mm.
A little wacky, but yeah, that's what it is. And yeah, you'd pay about 24% tax rate. And what that means is, yeah, you took home $1 million and you paid 24% in taxes. Whereas again, somebody who is a paycheck W-2 earner who earned that same million, by having a job or something, would have paid a much higher tax rate. And their marginal tax rate would be, at that highest bracket for a good line share of that income right now. Which, even with a new Biden tax plan, meaning it would be around 39%. And if your income is mainly through capital gains, as is likely sensible if you're wealthy, that what that means is, again, we may not have a progressive tax system here where you're actually paying less in taxes per dollar earned than somebody who is probably earning far less. And again, if you're earning over $1 million, then what they're saying is, yeah, let's make this a little bit more progressive for those individuals. One thing that goes through my mind is, let's say you have $1 million and it appreciates 10%. Your net worth increased by, if you have $1 million and it increases by 10%, you're at 1.1 million. You just gained 100,000. Well, in that case, what that means is that 100,000 currently would get taxed at the 20%.
But I think that's a good clarification, because this is just on the gains. So if you have your $1 million already, and let's say there's no gain, and it goes up to 1.1 million, you're actually paying taxes on $100,000 of gain if you were to sell and realize that. And so that $100,000 of gain would actually be kind of depending on your other income, which is that there's gonna be so many of those. Like, here's our guess based on this one single item, but depending on your individual household situation, all the other things going on as well. But that $100,000 might only be taxed at the 15%, maybe like 15%, depending on your income, plus a little bit of. We're not surprised if you pushed in over that 200 or 250 number, so plus the net investment income tax. So you're not necessarily going back to the ordinary income until your gain plus income gets over $1 million.
Yeah, and another way to think about it is, now you're talking about somebody who, let's say, has $10 million of net worth, right?
Mm-hmm.
You're at a 10x here, and let's say they have that same 10% growth. Now they have that $1 million coming in as income, and that $1 million is still taxed at the current rate if that's their only income, right?
Yeah.
So it's hard to say who this would be actually affecting. But let's say you had $100 million and now you made $10 million of income. Well, 9 of that million would be taxed at the higher rate. However, there's one caveat here. This is for realized gains. If you don't sell that position, that extra 10 million that you have in your net worth will be taxed at zero until you sell that position. So
Yeah.
that's another thing to realize as well.
Well, so that's actually a good point. In terms of that, trying to think of who this would apply to, I can actually think of two types of people who one I don't interact with as much. The other one I interact with all the time. The first one, it would be people who are selling a business, and while they've built up this business, sometimes these liquidity events can be millions of dollars all at once. So they're kind of their income might be in the few $100,000, because as they've built up this profitable business, and those profits pass through. So this could apply to small businesses or even slightly bigger, depending on what percentage you own of the business. But selling the business would apply and kind of push the income up over that $1 million, but it's usually only in 1 year. And so I'll kind of like want to get your thought on, is that fair to penalize the people who have built up those types of businesses because they cash out in 1 year? The other one I deal with all the time is employees of companies that worked at startups that have actually had successful exits, usually via an IPO. This is another scenario where they might get over $1 million in long-term capital gains, or maybe not about that much plus their salaries. That, again, same thing. It's only going to happen in 1 year. They're not kind of earning over $1 million in long-term capital gains every year. That would be 0.1% population, like really wealthy. Like you said, they have $100 million plus. But I do see scenarios where people earn a few $100,000, but once they had the liquidity event, that's where it tends to push the incomes over $1 million in a single year. And so that's why my first thought about it is one, was this penalizing or targeting the wrong people? Because I think that the headlines make you think, oh, long-term capital gains over $1 million, they must have $100 million to start with. Like, well, no. A lot of people, I think, will be, in terms of numbers, people who will be affected by this would be the ones who get kind of lucky and cash out on their startup IPO, because there's a lot of people who don't. A lot of people who take on that risk and go work for a startup, and it never pays off. And so it is kind of, I don't want to say, it kind of is penalizing the people who they're regular employees. They just their startup, their company happened to work out. And now, so for them, I'm thinking like they would normally want to sell a decent amount of their company stock to provide for their lifestyle. And there's a lot of other individual uses for that money. But now this is almost be encouraging them to not sell all in 1 year and actually spread out that sale over multiple years, which would imply that they have to take on the investment risk. They would have so much of their net worth in that single company stock. And so is this incentivizing? And actually, you can probably even do the math of like, okay, as long as, if we know the rates not, we can calculate, would you rather sell and pay 40%? Do you happen to know if the net investment income tax would be on top of that? I haven't.
They have not said. I assume so. I don't think they take away taxes where they add more.
So you might be paying, 43%, 44%, if you're going over $1 million. So like, do you hold on to it for an extra year? And you might be able to get creative, like sell some in December, sell in January. But here's what the loss the stock would have to go down for getting the long-term capital gains treatment spread out over multiple years to still be worth it. So you can actually start to kind of do that math of, instead of paying 43%, we can get it down to 24%. So very roughly, as long as the stock doesn't suffer a 20% decline, you're still better off holding on to it multiple years. But this is encouraging people to take on those risks with the vast majority of their net worth.
You bring up a good point, and it is a scenario that could potentially come up where, you have on the one hand, the $100 million household that is pulling in on, 1 million in, or over 1 million in income easily from investments. But then, yeah, there are these special situations where somebody puts their life work into a business, either as an employee or as a founder, and ends up with a windfall one particular year, and then what to do. Well, there are already a few things in place for these types of situations. For example, there's the section 1202, the qualified small business stock. It's something we mentioned.
Yep. Yeah.
Yep,
Yep.
we mentioned a couple
QSBS. Yeah.
times. Yep,
Yep.
the QSBS, where what that's basically saying is you can have up to 10 million in gains that can be excluded from tax if you have an interest in a small business. So that might go a long way to softening the blow for some of these individuals.
That's a good point. So if they really are, so you have to have owned the shares when the company is worth less than $50 million. So it kind of really implies, yes, you put some money at risk really early on, really high risk, and if it pays off, then yeah, you still get. I guess that number feels kind of a good arbitrary round numbers. Like, yeah, if your gain is still under $10 million and you've held it for greater than 5 years and the company paid off, then yeah, it's okay to get that part of the reward. But if your income is going to be $20 million, and you're the small business owner, then that might kind of feel more palatable.
Yeah, and the other caveat I'd say is, indeed, it's a situation where you might get a windfall and you kind of have to sell the stock. But what my brain is saying is that Wall Street will likely come up with some sort of solution for this type of scenario where you can set up an arrangement where you sell the stock to somebody else, but that sale, transaction happens over many years and it kind of gets amortized that way with an interest rate paid and so on. So I feel like for a fee, this could likely be solved.
There's actually already things like that. Like you could do something like an exchange fund,
Right.
where you are combining your stock with stocks of other companies. So you're trying to get like S&P 500 like returns. The fees are pretty high. It's very illiquid. You have to hold it for 7 years. But yes, there already are solutions and vehicles under current tax laws that could allow you to diversify without realizing the gain yet.
Right. So at the end of the day, I'm not sure too many people will be impacted with this to the point where it ends up being, again, something beyond, I'm just going to throw out a magic number here, maybe 1%, the population,
Yeah.
something like that, if not even less. And again, it's not necessarily, in my mind, it's not really a penalty. You're just kind of paying the marginal tax rate if you had earned this income through a job where you received a paycheck.
That's a good point. I acknowledge kind of, I try to be cognizant of like anecdotes and perceptions where I feel like the number is higher than 1% because I help clients with stock options. So I disproportionately see people who have these issues. And so for me, it's like, oh no, at least half of the people I deal with would be affected by this. But they're coming to me based on the things I've written on my website, based on some of the help I've given other clients, and like they're self-selecting into contacting me. So that's probably skewing my perception of how many people would be affected by this.
Right. May not be representative.
Exactly. Yes, exactly. Okay. So do you have any kind of thoughts on like the small business owners who are cashing out? Like it's the counter I thought. I know Elizabeth Warren has proposed wealth taxes a little bit more. Whether it's either 1 or 2% on like wealth or assets over 100 million, over 50 million, so some like really, really high number. Well, again, it's trying to target that same super wealthy. One of the biggest criticisms or concerns I've seen is if the net worth is in that business, that privately held business. So there's no public stock that's kind of determining the value of the company, and you can't liquidate parts of the business easily. Like, how would you actually pay a wealth tax if you own a small business or it's done really well, and so the business is now $100 million, but your income is still on the scale of a few $100,000 per year? How do you pay $1 million wealth tax bill? So, but yeah, maybe Wall Street will come up with all the solutions for them.
I'm sure there's a solution by some combination of bureaucracy, red tape, and Wall Street that can solve any problem that NASA can't figure out.
Yeah, yeah, that's a good point. It's like, oh, your business is worth $100 million. We'll help you come up with the cash for your $1 million wealth tax bill.
Right. So, just a matter of are we motivated to make this change? And if not,
Yeah.
then yeah, it's likely a non-issue.
But yeah, I do think like there are other ways to target households with that kind of wealth. And I think that's the important part of the conversation. It might be that ordinary income rates on long-term capital gains over $1 million, that might be a more effective way of doing it, because it implies that they have the liquidity. They still get some control. You still get to decide when to sell, and so you can still maintain some of that control. But the tax bill happens at the same time as the liquidity.
Right. And the sidestep that always goes through my mind is the best way to not pay taxes is never sell, and never have to pay taxes. Your money can grow perpetually. And that might kind of lead into our next bullet point here, where one of the big changes that we might see is the elimination of step up in basis upon death.
Yeah, this is a more interesting thought exercise. So you give us our primer on step up in basis upon death.
Right. So this is the notion that, let's say you do have a position. You bought IBM for $100 when you were.
Well, that's gonna be a bad example because IBM is always $100.
Yeah, that doesn't work here.
So you bought Apple at 10.
Right. You bought Apple at 10 and now it's worth 50 million. And you're looking to pass on the shares to your children. Well, currently, if you keep this 50 million in your estate and your children inherit it, those capital gains on that 50 million, basically all of that is gains at this point, would be taxed if you sold it, the day before you passed away. But if your kids inherited it and sold it the day after you passed away, then they would pay zero in capital gains.
Okay, so this is again really interesting thought exercise. One of the ways I have seen this play out currently is if you have a really, really high net worth, but you need to kind of use that money to provide for your lifestyle. Instead of selling and paying capital gains, because thinking like the Mark Zuckerberg, Jeff Bezos, Elon Musk, Steve Jobs prior, like they've built up so much of their net worth, and it's kind of concentrated in this one stock or one company. One of the strategies was to borrow against that net worth to support your lifestyle. You'd pay an interest rate on what you borrow, but the borrowing would be paid off by beneficiaries and heirs upon your death after you get a step up in basis on that large net worth. So there was a strategy where you could borrow against that depending on that step up in basis. One of the things that I have kind of recently learned, this is from a book by Tim Coates, it's about managing concentrated stock positions, especially from a financial planning perspective. One, this just doesn't affect as many people as we think it does. Two, there are kind of enough other financial planning and lifestyle concerns, usually related to that concentration risk, that while you could borrow against it, you start to get into kind of interest rate concerns and, again, unknown future tax law changes. So making decisions now, hoping that taxes will stay the same 40 years from now, is a big risk to take on. But when it came to some of those kind of time value of money thoughts and concerns and issues, for most people, if they're thinking about the planning, well, yes, we talk about an example of, yes, if you sell 1 year and then pass away the next, you've paid capital gains on all that gain. If you just waited that year, beneficiary get a step up. Realistically, it's closer to a time frame of decades. And so uh, if you're in your 60s or even your 70s and you have this large position that you're thinking of holding on to get that step up in basis, there probably was a more effective way to help heirs at a younger age than waiting for that step up in basis. Whether it's some combination of charitable lead trust, maybe a children remainder trust, but that would be more for going to charities. Sometimes some combination of gifting and estate planning could help them sooner. Kind of, you start to get into the risk of that stock has to outpace inflation and keep up with an alternative investment over a long enough time frame, that while the kind of the concept of the step up in basis feels intriguing, and if you have a shorter time frame, that could be a good tool. If you're thinking decades plus, sometimes it is okay to have a plan on how do we sell and realize the gain, to be able to either gift or put in some kind of trust that can help the beneficiaries sooner. And most all that growth that you're hoping, when you're kind of waiting for that step from basis, all that future growth would be in their estate as opposed to in your estate. And so that's just kind of one of the concepts where this is a great talking point, especially among politicians, but I don't know how applicable it is to most people.
It's interesting because as you had said that, I thought to myself, but wait, I know a bunch of people that this might impact, but then I'm like, but back to your earlier point, it's a little different with one subset of the population versus the median population. But at the same time, you do make a good point in terms of different strategies that are in play that somebody might be thinking about with regard to step up in basis. So the high level theme, for example, is there's two main taxes to think about when inheritance comes into play. One is the ability to take advantage of step up in basis and reduce your taxes that way. And the second is there's this estate tax exemption, which means that any amount below that would not be taxed by the estate tax, which is currently any amount above 11.5 million and change if you're single, and then double that if you're married. Now that's actually on the chopping block as well. We'll talk about that in a bit, but that might drop in half with the Biden tax plan. But the current trade-off today is the sooner you pull something out of your estate, the sooner it'll have the ability to grow outside of your estate, and then the less worry you have to worry about estate taxes. However, the longer you keep something in your estate, the more benefit you might get from the step up in basis. So there's this kind of trade-off or this tug of war going on. And it's a good point that if the step up in basis were to go away, well, then there just might be more emphasis on moving things out of the state sooner rather than later, which again may provide benefit to heirs sooner rather than later, which could be a good thing. And also the other thing to think about is that if the step up in basis might go away and the estate tax gets lower, well, that's also another reason to get assets out of the estate sooner rather than later, because once those assets are out of the estate, then they will be not subject to the estate tax amount, even if those amounts happen to go lower. So that does make sense to me. In terms of what somebody might do in terms of the step up in basis, I think if it's going away, it does make a lot of sense that, yeah, a current strategy these days, for example, is if you have assets with a high amount of basis, well, meaning if you have assets that, for example, have appreciated a little bit, well, these days you want to sell those first, right? Because you want to keep the assets around that have a lower amount of basis, a high amount of tax burden, so that you get the step up. Well, that becomes less of an issue to think about, which may change the way you plan things. But also the other thing to realize is if a step up in basis goes away, you still have the option of, Aaron, what you had mentioned with the giving, you can gift shares to individuals who might have a lower marginal tax rate. So that's something to think about. And you can only gift a certain amount over your lifetime. So you also have to play that in to how this calculation works. But again, it just seems like this will make things a little bit more complicated, certainly keep us busy, but there may be workarounds to kind of mitigate the impact of this particular change.
Yeah, I do. I'm almost curious. I don't know where the concept of the step-up basis came from. Like not necessarily the actual like tax law or politics at the time, but I I was trying to think. I was like the political theory behind it. Like this has always felt like a weird like arbitrary something thrown in. Like, the only thing I can think of would be with property. So if you inherit your parents' house, um, and you're trying to hold on to it, but if you were to owe taxes upon like selling illiquid assets kind of thing. So maybe it is related to that where um, it doesn't force you to sell your parents' house to pay the tax bill. Kind of, you can take time to figure out what you're going to do with that. Um, I know in California, if it's structured correctly, you can sometimes keep their property tax basis as well. So it's a little more palatable to stay in your parents' home. That California has been trying to be cognizant of how much some real estate prices have gone up. So if a couple bought a place in the 80s or 90s when they were 50 or 60 and they've paid a few $100,000, it might be worth over $1 million, if not over $2 million. And so they've been living it their whole time. So that's what kind of that was the impetus behind California's Prop 13 that keeps property tax values closer tied to the purchase price plus inflation, not current market values, because there were enough people who they happen to have bought a place a long time ago. They've seen their home value go up dramatically, but it doesn't mean they have the income or other assets associated with buying a place that expensive. And so there have been enough kind of age help. So if you're over 65, there are certain benefits and exemptions. If you inherit your parents' house, they try to provide certain benefits exemptions. So I think that's my guess of where this started from. But yeah, this is one of those things where if you have an asset that has a significant gain, then that might be the thing that should be taxable. So if you
Yeah.
pass on an IRA or a 401k, that's taxable. It's actually taxable as income to the inheritor, to the beneficiary. So why should a capital asset outside of a retirement account be given so much preferential treatment?
Well, we can probably guess which demographic of individuals this benefits more and probably work our way backwards from there.
Yeah,
That might
yeah.
help a bit. But, there can be fuzzy notions out there, like you said, of, yeah, it's too hard to do, or it's going to be too tricky. What if we can't figure out the basis, that what do we do in those situations? Somebody inherited something and, well, there's no paper trail. What do we do there? And so on. So, but my mind kind of goes back to, well, if we really wanted to, I'm sure we could figure it out. We can get our top minds on this and kind of move on. There's probably just not enough motivation to affect that change. But who knows? Maybe with the Biden tax plan, there'll be some motivation to get this changed.
Okay. Okay. What was next on our list of things to look at?
Well, since we did bring up the estate tax exemption amount, and we are talking about step up in basis, that is something that's on the chopping block. So the notion is, over the past administration, the estate tax exemption amount has jumped from about 5 million and change to around 10 million and change, and it's kind of grown with inflation since then to like 11 million and change.
So growing from I think it's 10 or 10.5 to 11.58 in a few years. Like, man, small percentage changes on really big numbers are still really big numbers.
Right. And what that means is, if you're married, you double that. So if you have an estate that's less than 23 million today, and that passes on to your kids, well, that won't be taxed. But if you have a estate that's, call it 24 million, and you're pass that on to your kids, well, then that extra couple 100,000 would be subject to like a 40% tax or so.
Yeah. So this is one of those things where trying to find the number is always like arbitrary politics. Like, yeah, I actually saw, especially being in California, especially with real estate prices having gone up, a state tax exemption of $1 million did feel like it affected too many people. It goes up to $2 million, kind of includes the inflation a little bit, 3.5, goes up to 5 million. Like, okay, I can see that. Jumps up to 11.58, and all the other client situations where I was talking about where they have a $1 million stock IPO, like there's no concern about estate taxes. It's kind of like it was affecting the right people. And like, okay, now there's no concern at all, and then it comes back down to 5. It's like, well, I hope they have a good idea to increase that with inflation, because like currently, no, it doesn't affect any of my clients, but in 10 years, yeah, I think some of my clients between homes and stock assets could project to get up above that number. So I think that's one of my concerns. Like, bring it down to 5, that's fine, but I want to make sure it does increase on a regular basis. So I think I almost hope they keep that part of it, because that has been an issue in the past.
It has, and you can imagine if somebody's even in their 40s and they have 2 million in wealth today. We mentioned how with the market rate things can double every 10 years. So, 2 goes to 4 to 8 to 16 to 32. By the time you're 80. So that $2 million, if you let it ride, you'll likely have an estate tax concern that you want to maybe plan for sooner rather than later.
Yeah. So I think it's an arbitrary number, but I thought 5 million was fine, especially if 5 million single and still 10 million for a couple. As long as they have a good either procedure or it's built in to have it increase with inflation or something like that.
Right. Yeah, so the lowering it by 50% will probably bring us back in the territory from today. We mentioned this when we first talked about the current exemption amount in our estate planning episode, where it only affects a couple hundred people a year that are passing on estates above, 23 million, for example. Whereas now, if they do end up moving it back, it's basically on the table in terms of a good conversation starter when we think about estate plans.
Yeah, I think this is also targeting that top 1% again. It's 1% of household net worth. I think was roughly $11-12 million, something like that. The numbers might be a little out of date, but if you have a married couple and your net worth is under $10 million, then yeah, you won't be affected by this. But if you're in that top 1%, then yeah, you can, one, you definitely afford to pay it. Two, like that's kind of what the politics and trying to bring down some of the income inequality and net worth inequality in the country is designed to do. That's what we're trying to do. So I think that's another where we're targeting that number is we can probably increase taxes on that top 1%. Doesn't change their lifestyle at all, but it is trying to make things a little more fair for the rest of the country, for the rest of the 99%.
Yep.
Okay. What was next on our bullet points of things that Joe Biden proposed?
Yeah, we have this retirement contribution credit of 26%.
Okay, so I know I mentioned the 401k and IRAs and those get taxed going to heirs. This is actually talking about the deductibility of contributions to IRAs and 401ks. I remember when I first read this, I needed to read a couple times to make sure I understood it. So I'm going to let you describe this better than I can.
Well, I was scratching myself as well, but I pulled together some tea leaves, and I think I have a bit of a grasp, but again, it's not clear in my mind completely. The way I kind of see it is it has to do with contributions to a pre-tax retirement plan, like a 401k, a traditional 401k, or a traditional IRA. So typically how that works is, let's say you put in $5,000 into either of those plans, well, you would get a deduction based upon your marginal tax rate for that $5,000. If you're paying, call it 30% in taxes, you'll get a deduction on 30% of 5,000. So that's pretty good. So with this plan, what they're saying is,
let's check. So if I'm in a household where our combined income is $80,000, we're at the 12% tax bracket. We put money into a traditional IRA or 401k. We're getting kind of our marginal rate is 12%, so we're getting a 12% reduction, or reducing our income taxes at the 12% rate. So instead of that $5,000, we would have paid 12% on it. We get to reduce that 12%. But for higher income earners, when they put money in their 401k, they actually get to deduct at that higher rate. So they get a 37% benefit or a 35% benefit. So they get a better deduction for being in that higher tax bracket. They get more of a deduction from retirement account contributions.
Yeah, now with the new 39.6% tax bracket, that's what somebody would likely get. They would get a 39.6% deduction, whereas also somebody, if they're very low income or even up to 80,000, then they'd only be getting 12%, which is far less than 40%. And there's some notion that this may not be as progressive as well. And the notion with the flat retirement contribution credit is everybody would get 26%. So if you are in the 80,000 land today and you would get 12% today, well, no, instead you'd get 26%. You get a higher credit.
You actually get a bigger deduction.
Right, a bigger deduction today.
Okay.
Yeah, and then if you're in the 39.6% bracket and you made that similar contribution, you wouldn't get 39.6%. You'd get a smaller deduction of 26%. So you can see how that helps perhaps make things a little more progressive in terms of contributions to a 401k plan. And again, I'm not entirely sure I've read the tea leaves correctly on this one, but that's my understanding. And again, there's still a caveat that a lot of this is still fuzzy anyway.
So try like, do you know how to even calculate that? Like I think I understand the concept, but if I make $80,000 and I contribute between husband and wife $12,000 to each of our respective IRAs, we're going to pay taxes as if we earned $68,000 before any standard deduction for anything else. But so kind of, I can see how it reduces the income based on our that the calculation is based on. So now I'm wondering, do I gross that up a little bit, or do I calculate it based on a lower income number? So do I do like the difference between 12 and 26% will be a 14%? Do I make my calculation as if I did $12,000 plus 14% is 13,680? Do I do the calculation as if I subtracted 13,680 from my $80,000 income instead of 12%? Like, do you see my question?
I do see your question, and I think that's why they're calling this a credit instead of a deduction, because they're not necessarily reducing your taxable income and then you pay your marginal tax rate. They're likely saying, okay, this is the credit you pay based upon whatever your contribution is, and then your marginal income is what it was before.
Okay, so okay, I see. So they're calling it a credit so that once I figure out my tax bill based on my deduction. Oh no, in this case, it wouldn't even be
based
a deduction.
On your contribution. Yeah, it's not a deduction. It's
so
credit.
I calculate taxes based on $80,000.
Right.
I put 12,000 in, so I'm getting a 12,000 times 0.26, so 3,120. Whatever my tax bill is based on 80,000 of income, I've reduced that by 3,120, which is 26% of my 12,000 contribution.
Right.
Okay. Okay. I think I got that. It changes the timing of the calculation. It's no longer deducting from income before the calculation. It's reducing the actual tax calculated after the calculation.
Yeah, I'm sure it'll add about a dozen pages to our tax code.
Well, I guess, how big is the tax code now? Because I'm more worried about the actual like 1040. I'm actually worried about like the forms I have to hire a CPA to file for me.
It'll definitely keep us employed,
Or
keep employment high.
Yeah.
It'll keep the population employed.
Okay. So I think that makes sense. So in this case, now if I'm in the 35% tax bracket, so my household income is $300,000, then I still calculate the taxes based on that $300,000, but now the 12,000, instead of getting a 35% reduction, I'm only still getting the same $3,120 deduction from that tax bill.
Right.
Okay. I wonder if that almost makes it easier to calculate.
Hard to say. I feel like you know how disorder always goes up in the universe. I don't think it ever gets easier.
Okay.
There must be some law where
to be fair,
time goes on, tax code gets more complicated.
I have become aware that I can't keep in my head the adjusted gross income, your modified adjusted gross income, your taxable income, your like net income, like
your AMT income, your
I don't even bother.
Income, right.
It's like, okay, yes, this is why we're hiring a CPA. But that's their job to remember these things.
Yeah, and then you have a form to fill out. It says, "Please provide your income."
Yes.
You just-
I because I do know like okay, no, hold on, I take that back. I don't know. I'm pretty sure your modified adjusted gross income adds back in your retirement account contributions from your adjusted gross income. But I think there are other things that would go into your modified adjusted gross income that I am not quite aware of.
Right.
So, okay. Anything else on the Biden tax proposal that was worth mentioning?
Well, the last few are just a few bullet points, so I'll kind of just rattle them off. They kind of just are what they are. And again, we don't know too much beyond what I'm probably just going to read off here. But for example, the child tax credit has been proposed to be increased from $2,000 for children under 17 to $3,600 for children under 6, and $3,000 for all other children under 17.
Okay. This is also like there's the different stimulus and appropriations bill that are also kind of impacting this. So we might get not just a Biden tax proposal issue, but also kind of different COVID related economic stimulus packages that also affect these numbers, I believe.
Oh yeah, for sure. And those will also keep these conversations busy. So a few more related to these types of credits. So the child and dependent care credit might jump from 3 to 8,000 for one child, and from 6 to 16,000 for two or more.
Okay.
And the first time homebuyer credit would be reintroduced as a refundable and advanceable credit of up to 15K.
Okay.
And then finally, there might be a brand new proposed child caregiver credit for a 5,000 for informal long-term caregivers.
I don't think this one is specifically child related. I think this was a caregiver, so it
That's
could be
right.
for
Yeah.
adults or say adult parents who require care.
Yeah, good point. That it could apply in those situations as well.
Okay. So it does seem for some of the things that we kind of talk about, that especially like some of the child credits and those really helps families, those with children. But anything that was kind of penalizing, it did feel like it was really targeting that top 1%. So if you're in the top 1%, congratulations, you have a pretty good net worth and income or some combination thereof. But there's a realistic possibility your taxes will be going up. Now, the big question is kind of, will they be going up greater than it costs to hire a CPA and tax attorney to move things around? So just like always.
Right. And if it is, outsource it and kind of move on. Right.
Yeah. Okay. Well, this is, I know it's a little dry, a little technical, but I think it's worth the conversation of some of these things that at least you understand the concepts behind them. So the numbers will probably change based on negotiations, what actually gets passed by Congress, signed by the president, but at least you understand kind of how these might impact you and start to think about it from that perspective.
Yeah, good point. I enjoyed the conversation as well. And I'm hoping that it did clear the cloud on some of this stuff. So good stuff, Aaron.
Yep. Thanks.
Great. And thanks everybody for listening. If you're enjoying these conversations, do spread the word.
Bye.
Bye.
We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.